Welcome to Phillip Roundtable. My name is Kim. As we all know, US has just concluded its presidential election with Donald Trump securing 312 electoral votes, outperforming Kamala Harris in the latest presidential election result. And meanwhile, across the pond, post the election, we see Asian markets performance has been lackluster. And here today, we are honored to have three distinguished speakers with us to share their thoughts on the market post-US president election. Allow me to introduce our speakers. The first speaker is Professor Dr. Wong Chin Yong. He's currently a professor of economics at University Tunku Abdul Rahman, Utah, Malaysia. He obtained his PhD from University Putra Malaysia, UPM, with his thesis working on the macroeconomic effects on global value chains, awarded with distinction. The first in the Faculty of Economics and Management in UPM since 1974. He has been the visiting research fellow at both Kingsley Advisory and Strategic Initiatives, KSI, in Malaysia and the Stockholm, China Economic Research Institute, FCERI, in Stockholm. In addition, he's a valued member of the Harvard Business Review HBR Advisory Committee. Dr. Wong works go beyond the academic community. He has been appointed as economic consultant for both the public sector and private businesses, including United Nations Development Programme, Ipoh City Council, Sarawak Economic Planning Unit, Federation of Malaysia's Manufacturers, MyStart, Tenaga Nasional Berhad, Malaysian Institute of Economic Research, INSEP, and Hua Zhong. Above all, he's a public intellectual reaching out to general audiences via hundreds of writings, which include book chapters, reports, and columns, and public appearances as invited speakers, commentators, and resource person to printed, audio, visual, and social media domestically and internationally. He's a columnist to Nanyang Siangpao and contributed regularly to the Malaysian Insight and the Smart Investor. He hosts a TV program at 8TV called Money Matters Mandarin to discuss topical economic, business, and finance issues domestically and globally with invited professionals and business leaders. His most recent book is titled The World in Flux, Navigating Malaysian and the Global Economic Mandarin. Our second speaker is Ms. Doreen Chu, the head of investment from Eastspring Investment Berhad. She joined Eastspring Investment Berhad, EIMY, in August 2018 as head of investments. With more than 20 years of industry experience, Doreen joined Eastspring from CIMB Principal Asset Management, now known as Principal Asset Management, where she held fund management roles from 2005 to 2018. Prior to that, Doreen worked at PwC from 1997 to 2005, providing valuation and strategy advisory services with a particular focus on equity valuations across various industries. Doreen has been a CFA charter holder since 2002 and holds a first-class Bachelor of Arts degree from the University of Malaya, majoring in economics. Our third speaker is Ms. Pamela Yao, Managing Director, Client Service Manager, Asian Equities, from Manulife Investment Management. Based in Hong Kong, Pamela Yao is a managing director and is responsible for the coverage of Asian equities with primary coverage on China-Hong Kong equity strategies. She works closely with the China-Hong Kong equity investment management teams and is the primary resource for communicating the key features and attributes of the company's Asian equity strategies to existing clients, prospects, and consultants globally. Pamela has over 20 years of experience with a background in equity research. Before joining Manulife Investment Management, she was Director in Equity Advisory at HSBC Private Bank. And prior to this, she was an investment counselor at Citi Private Bank and equity specialist at Merrill Lynch Wealth Management, Bank Julius Baer, based in Hong Kong. Earlier in her career, Pamela worked as consultant with Deloitte Consulting in Toronto and as an equity research associate with RBC Capital Markets in New York City, United States. Pamela holds a Bachelor of Applied Science in Systems Design Engineering from the University of Waterloo, Canada, and an MBA from University of Toronto, Canada. She's a CFA chartered holder. Right, let's start with the first question. Probably we can direct a question to Professor Dr. Wong on the US presidential election. Would you like to share what strategies has Donald Trump employed to secure his victory? And following the election, how should investors adjust their position, specifically which sectors are likely to then benefit or lose, or geographically, which countries stand to gain or lose following the US presidential election results? Over to you, Professor Dr. Wong.
All right. Can you unmute me? So I guess everyone can hear me. So good afternoon to everyone. Thanks for the invitation. So I guess this is my first time to this Phillip's Roundtable talk. All right. So now that's definitely a huge question, right? In fact, it's questions. Three questions in there, and I believe that I mean, for the US, all the pundits and all the community, they are still searching for answers why Donald Trump can be winning a landslide winning kind of, even though before the election. So when it comes to the polls, it was some sort of it's a tight situation. Now, so as far as of course, I must say that I am just a casual observer to U.S. politics and the U.S. economy. But from my readings and my observations, now a very important strategy or a very important characteristics of Trump compared to those Democrats candidates, Harris, for example, was that he was very, he always talked to the ordinary people, even though from even though we can say that in the way that Trump's deliver his speech or the way that he communicate with his audience, it's kind of jokes, it's ridiculous, from a normal kind of judgment, but and even the answers given, for example, it didn't sound rational at all, but he always talked to the questions, the concerns of the ordinary people, Like, for example, in the United States, about 60% of US people, they are living paycheck to paycheck. Even though from statistic point of view, then we can always say that US economy probably is the best in the past 10 years, with a very strong growth and with, being able to tame the inflation, with stock market rallying for decades, breaking records again and again. So from that point of view, US probably is the best among all the advanced economies, probably even compared to those developing countries as well. So from that point of view, then Democrats always will have a say that, see, look how well we manage the economy. So we are not going back. So we'll be moving forward. But like I said, for a lot of ordinary people, when they are living paycheck to paycheck, so they are not concerning about those beautiful numbers, but they're concerning about their daily life. So that is how Trump responded to their needs. Even though, like I said, the responses given, they are like, we have fingers pointed to the immigrants. They come and eat the cats and dogs, so on and so forth. It sounds ridiculous, but at least he has an answer and he's connected to the audience. And I guess that's the most important point, that Trump has won the election. That and when I say won, it is he basically attracted almost the votes from almost every strata in the United States, whether it's white, it's black, it's Hispanic, whether it is the old, whether it is the young voters, those below 25 years old. So he basically make a gain in all these different kind of segments in the society. So therefore, not only that he won the popular votes, but also from popular votes from all different segments. So in that sense, it is a phenomenal victory for him and for the Republicans. Now, and because of that, therefore, so come to your second questions, then we can pretty sure that whatever he mentioned during the campaigns are going to be realized, are going to be implemented, are going to be executed. When he really take over the administration. Like for example, the mass deportation, for example, the deregulation for the banking sectors, for the financial sector in general. For example, tax cut, the extension of 2017 tax cuts. For example, the being a tariff man. So those will be having a huge impact on the exchange rates, on the trade, um, especially for open economies like Asia, like Malaysia. It's going to have a huge impact on the way interest rates cycles. You probably can expect the interest rate cuts, will come to an end very likely. So they are going to have a lot of impacts. I believe, we will have more, discussion later on. So those are the things that will have, again, reset everything we have expected so far. Like we expected, for example, interest rate cuts will continue. Therefore, ringgit will gain strength, for example, in the next year. And some even will expect that gold prices and other commodity prices generally will have a better rally, for example. So those are the expectations. Probably will have to come to a stage where we have to make a reset on all those expectations.
All right, thank you, Professor Dr. Wong. We hear you on the strategies that Donald Trump has employed to secure in his recent victory, and that has actually, he has actually got a lot of support from all kind of segments across, the voters. And we also hear you on some of the plans that he is going to execute, say tariff, say deregulation, and the likes. So just like you mentioned that probably you are seeing that because of the global central bank easing, right? The Fed would cut rates, so that can probably benefit ringgit currency. So, but to counter that, we see that Trump's policies, such as tariffs, such as expansionary fiscal policy, that could actually, lead to some strengthening to the US dollar, prompting the global central bank, the likes of Fed, to probably increase more interest rate in order to combat with inflation, and hence net probably dollar may not be as weak as we think, and regional currency could be under pressure. What's your thought on that, Professor Dr. Wong?
Right. Two perspectives. Number one, if we read from historical records, because we did have tariff 1.0 from 2018 March onwards until before the onset of COVID. So what we observe when it comes to the US dollar, so US dollars gain strength within that period. So that is one sort of judgment. And of course, you can also expect that things to happen again. This, when tariff 2.0, tariff war 2.0 is coming. So because you need a strong dollars in order to reset whatever tariff has on the global trade scenario. So that's almost something that we can assure. Number one. Number two, which means what? Which means that you probably are going to observe a rise of inflation, or at least a stop of, or at least a kind of plateau in the achievement, the gains in inflation reductions that the US or the Fed has achieved so far, right? So which means that in order to go back to their initial target of 2%, so that will be some kind of last mile that they may not be able to achieve. So which means what? Which means that will therefore very likely to make the Fed to be more hesitate when it comes to the interest rate cut cycle. All right, so that's number second. Then the third point is, if mass deportation takes place on the very first day of Trump's being the president, the next president, then that mass deportation, you're talking about deporting more than tens of millions of so-called illegal immigrants out from the United States. So you can imagine that the chaos that it will cause to the businesses community in the United States, particularly for those who are more on the ground on service sectors, are going to have impact on the prices because they are going to have disruptions on the supply side and therefore the impact on the price. So that would be the second factors that we have to count in when it comes to, I believe the Fed will count in when it comes to their interest rates consideration. So I would say that, like Kim, you mentioned about the net effect. So as a matter of fact, appreciation will have very minimal impact on the US imported goods. Unlike what we say that appreciation usually will make imports cheaper because most of the imports, they are priced in US dollars. So they are therefore not likely to be affected much by the fluctuation in the US dollars. So therefore, we can basically minimize any positive impact of appreciation on the inflation. Therefore, give more weight, greater weight to the second and the third reason. So therefore, it means what? The likelihood of interest rate cuts being halted, being slowed down, or even being reversed, the probability is increasing at this moment.
All right. Thank you, Professor Dr. Wong, for your sharing. Over to you, Doreen. What's your thoughts on the latest US presidential election? And following that, how should investors actually position ahead? Which sectors are likely to benefit or lose, and which countries stand to gain or lose? Over to you, Doreen.
Thank you. Thanks for having me today. So what was touted as a close call wasn't such a close call after all in this election. Trump's resounding victory has led to some soul searching, I believe, in the Democratic Party. So was it a case of a late candidate switch? Was it because of a weak Kamala Harris campaign? I don't think so. I think that it was Trump's ability to truly focus on the issues that matters most to Americans, right? So quite similar to what the prof said just now, the economy, inflation, as well as the immigrant situation in America. So I guess Trump was able to connect with the pain and at times the anger of the people, the men on the street. So they could relate to his message of, a troubled economy, despite the beautiful headlines, of a strong US economy, etc., etc. But so to them, they felt the pinch in their pockets, I suppose. And to seek change, the easiest way is always to vote out the incumbent. Yeah. I think the other point to note is also a trend that we see emerging in the past 10 years or so, I believe, which is political polarization, by education level, so to speak, an education divide, right, which is quite high today as it was before, but today it's in reverse. So the Republicans now are seen to appeal to the masses, while the Democrats have evolved into being an elitist sort of party, for the highly educated. So maybe this explains the disconnect felt by the masses with the Democrats. Yeah. So coming to your question of how investors should position themselves, well, I think we should then ask, what does Trump stand for? What are his policy proposals? What will he do to achieve his vision to make America great again? MAGA, right? MAGA. So just very quickly, Trump is seen to be pro-growth, to be business friendly. He is known to be a deal maker or a very transactional kind of president. So from his speeches and statements, he has said a few things. So just a few key highlights, which the professor has mentioned as well. Taxes, right? He wants to reduce corporate income tax rates from 21% to probably 15% for US companies producing domestically. Tariffs, he indeed is the tariff man. He basically has said that tariff is the most beautiful word in the dictionary, and it is a key part of his campaign, right? But tariffs truly, I believe, is a lose-lose kind of endeavor. So he plans to impose 60% tariffs on Chinese goods and about 10 to 20% kind of baseline or blanket tariff on the rest of the world, right? And also to impose the same amount of bilateral tariffs as the trading partner through the Trump Reciprocal Trade Act. Immigration, as mentioned, mass deportation. And in terms of sectors, I think he wants to revive the US industrial base, giving priority to defense critical sort of industries, right, to ensure that equipment and parts that are critical to US security is made in the US. And auto, he wants to reduce regulations on the auto industry, but at the same time, he also wants to cancel EVs, right? Electric vehicles requirements. So it's a negative for EVs, and he also wants to prevent the import of Chinese vehicles. On energy, he's famous for drill, baby, drill, right? So he wants to stop the Environmental Protection Agency's rule on electric vehicle standards, which requires auto companies to have 56% of new vehicle sales in EVs by 2030, for example, right? And in terms of energy, I think it will set back the climate transition agenda. He wants to deregulate energy production, build a wide range of sources of electricity, including coal, nuclear, but not wind, right? And he may actually repeal some of the Inflation Reduction Act items, maybe some of the spending that is not actually allocated out yet, right? Healthcare, he wants to ensure the production of essential medicines in the US and phase in import restrictions, especially from China and the US. And in terms of technology, maybe it's also worth a mention that he wants to loosen regulations on the crypto industry, right? Foreign policy, end the Russian war on Ukraine, continue to support Israel and seek peace in the Middle East. But something is brewing now, has escalated now overnight, right? So those are some of the policy positions proposed by Trump. So which sectors are likely to benefit or to lose? If you're talking about the US market, I think I mentioned a couple of things just now. So technically, we believe that Trump is positive for US equities, right? Sectors such as banks and technology will probably benefit. Defense will probably benefit as well, because I think Trump wants to expedite the US stepping down from its role as the world's police, and he wants he views probably foreign policy in transactional terms, right? Auto manufacturing will probably gain, but EVs will lose. Fossil fuel will gain, right? But green energy will probably lose. Healthcare will probably also gain because Trump wants to expand domestic manufacturing of essential drugs. Construction may also benefit due to a potential refocusing on infra kind of spending. But consumer discretionary may be negatively impacted because eventually, with the tariffs and the higher costs and such, the end consumers in the US may have to bear the brunt of the higher prices. As a research actually suggested that importers and end consumers in the US bore the brunt of the US-China trade war earlier on, right? And this could be negative on the consumer discretionary sector. If you're talking about, let's say, emerging markets, how should you position yourself? So generally, this is not great for emerging markets, right? Because of higher for longer rates, probably, okay? Meaning that although the US is in a cutting cycle, this could actually slow down that cutting, right? Reversing it, I'm not so sure, but it could slow down the cutting because of expected higher inflation, right? And then this could lead to stronger dollar and then portfolio outflows and things like that. So generally not so great for emerging market. But in the short run, the US importers may actually front load some orders ahead of tariff hikes, for example, right? This part of the world could also benefit from the China plus one kind of strategy to accelerate trade supply chain, reconfiguration. Sectors such as tech, data center, green energy, some properties and banks may benefit, as we have seen Malaysia benefiting from this. However, we have to be clear that, the blanket kind of tariffs that China, that the US wants to apply across will also impact this China plus one strategy because, other countries are used as China's conduit, right? export into the US. So if this 10-20% kind of blanket tariff is also applied across the board, then technically we have to look at the potential impact on this whole China plus one strategy. So a strong US dollar, for example, yes, at face value is good for exporters, semicon and autos and all that. But as mentioned, it is precisely this segment of exporters that is subject to tariffs and should therefore see more volatility from this entire tariff policy, right? Because US wants to stop countries acting as conduits for China, for example. Just a little bit more, Trump is looking to tighten trade terms with Mexico and ASEAN, so maybe consumer discretionary will be impacted as well. Clean energy sectors could probably lose momentum. Yeah, so that is generally a very broad kind of picture of the expectations across different parts of the world as well as sectors.
All right, thank you, Doreen, for your comprehensive answer. We hear you on the strategies to be employed by Trump, and we also hear you that probably U.S. equities will still be doing well. All right, U.S. dollar likely to continue to strengthen. On the other hand, emerging markets may suffer, but not all sectors will suffer. Of course, some of the sectors like your exporters may benefit, right? Tech may benefit as well, but those that actually, they are involved in clean energy sectors may likely to lose momentum, as you mentioned earlier. But speaking on that, we all know that Elon Musk has been helping Trump in running his campaign, and before the election, he actually mentioned to the public that he can actually help Trump to actually help US to save US dollar 2 trillion, right? In Trump administration. But at the same time, Elon Musk is also an owner of Tesla. It's an EV company. So how does Trump policies can actually benefit Elon Musk? Over to you, Doreen.
Well, we don't know, right? We're putting together two very volatile personalities, right? But it is conflicting in a sense because Trump is still keen on fossil fuels, right? Which is going to detract from the clean energy kind of agenda. So the question that you have asked is also asked by a lot of investors, for example, is like, why are we pairing Elon Musk with Trump? Why is Elon Musk supporting Trump in his agenda, funding him, right? So it is very strange because I believe Elon Musk has also appeared in some of these, some of these official meetings and things like that, right? So I've got no answer for you, right? But let's see where it goes in terms of the clean energy agenda.
All right. Thank you, Doreen. Pamela, so what's your thought on the US presidential election? And we all know that your research area of focus is mainly on Hong Kong and China markets. So do you think these markets will likely to be more volatile in the upcoming years? And how should investors adjust their position accordingly? Over to you, Ms. Pamela.
So overall, we expect noise between China and US to stay, as we all know that Trump is known to be quite unpredictable, and hence there could be more uncertainty for sure on geopolitical issues. But even so, if Trump introduced a minimum tariff of 60% imports tariff on China, or potentially 10 to 20% universal import tariff on the rest of the world's import, we think investors should take note of three key points. So the first point being is that if we look at tariff actions are not new, like Professor Wong suggests. It has been implemented by the Trump administration since 2018. But note that since then, actually China's export to the US has declined, while export to the rest of the world has picked up. So for example, back in 2017, China's export to US was standing at 19%, and it has reduced to 14.8% by the end of 2023. Whereas export to the rest of the world actually rose from 20% back in 2017 to 23.5% in 2023. So what that means is that China export less to the US, but more to the rest of the world, and that should also help mitigate the tariff situation. The second point we think is that we believe China will continue to boost import substitution and self-sufficiency in the longer run. So you can see that recently China rolled out a series of monetary and fiscal stimulus, which we think is very powerful and could steer the economy going into Q4 and going to 2025. We favor companies that are more exposed to the domestic consumption theme in the portfolio. So overall, we think domestic companies are more immune from these noises. And also the third point is that we also seen some companies with very strong overseas market exposure, and they are early movers who have been basically diversifying into, for instance, Europe, into Germany, into Brazil, and they have been building factories globally to localize their operations. And in a way, this is good because they bring along the technology and and they are global leaders with cost competitive advantage. They also bring along the supply chain over there. So all in all, it helps these innovative leaders to sustain their overseas market exposure. So despite all the geopolitical headwinds, we still think that a lot of Chinese corporate companies are, we call them valuing up. As you know, year to date, actually, if you look at the total dividends and share buybacks in China among corporates, on track to reach renminbi 3 trillion this year. And nearly 600 companies are distributing interim dividends, reaching all-time high. So all in all, we think there are a lot of opportunities. And as China encourage companies to improve shareholder value, these moves we think are very positive.
All right. Thank you, Pamela, for your sharing on China. But a lot of investors are actually concerned on whether the Chinese government can sustain their policy momentum. We all know that since September onwards, the Chinese government has been very active in announcing policy stimulus in order to sort of regain confidence and probably to support the momentum. But execution is the key. What's your thought on this? And there are also another thoughts on the tariff as well, whereby Chinese policymakers may need to devalue the currency in order to absorb some of the possible impact from the tariff. What's your thought on that?
Sure. We think if you look at the recent announcement by the Chinese government, it is actually a 180 degrees change versus before. Maybe before you might hear policies announcement, but you haven't seen a lot of concrete action. But this round of announcement in September and October, you can see clearly there are 4 law of actions. For instance, companies, when they announced their swap facilities, actually companies subscribing, and they are actually there are things in the works. So we believe that execution is going to be ongoing, and also with the MPC announcement back in November, we have seen that China's government is very determined to have more stimulus, not only on the macro front, but also on the property side and consumption side. So all in all, we think this is actually very powerful. And to your second question, we think Chinese government has a lot of tools and in the toolkit to maneuver the situation, and not only on the currency side, but also recently China also reduced the rebate. And this is another tool that, there are other ways that Chinese government can maneuver the situation.
Sorry, Pamela, can you share more on the rebate?
Yes. So basically, China just recently announced that there's more export rebate on a variety of sectors, reducing from 13% to 9%. So markets see this as a preparation that this is a move to, if there are more tariff coming from the US, this is another way to counter it, to help enterprise. So this is just one example of how China can actually mitigate a lot of these headwinds.
All right, thank you, Pamela. Professor Dr. Wong, not sure whether you would agree that geopolitical tensions between the East and the West, or even in the Middle East, could be the biggest risk to the global market next year. In fact, the IMF in their latest World Economic Outlook has actually mentioned that the global growth is expected to remain stable at 3.2% next year. But of course, they also flag some of the risks, such as geopolitical tensions that could probably create some pressure to the global market's growth trajectory. So, what's your thought on that? Do you think the geopolitical tension likely to escalate or de-escalate?
Right. Before I address your questions, I want to address what Doreen and Pamela has mentioned about what the questions that investors to Doreen have about why the pair of these two big ego men, how Tesla can benefit from Trump, as a job nationalist. Now, Trump is a job nationalist, is not a brand nationalist, which means that with all the tariff, for example, with the intention to bring back manufacturing jobs into the United States, irrespective of brand, it doesn't matter whether it is the US companies, or it doesn't matter whether it's the European companies, or probably not even, it doesn't matter if it is the Chinese companies. And to invest, therefore, in the United States, for those Chinese companies, in fact, this is what they are eager for. Now, so I wonder if, when it comes to, like Doreen has mentioned a couple of times, that this is more toward the transactionalism foreign policy, where personal relationship becomes more important when it comes to on the table of the deal. So could it be, for example, that the most important assets for Tesla very likely is not going to be the cars, but it's going to be the software for those the operation. So what if for example, it allows the EVs cars, the Chinese manufacturers, to come over to the United States and set up factories there and produce jobs there, but with the conditions to use the Tesla's software, for example. It becomes like win-win for both. Ego man, then Tesla will have a big money in there, and then it also create jobs, for Trump to claim a victory. So we don't know, but that seems to be something possible. Now, and then for Pamela's, because I am also attracted to the questions about the exports subsidies reductions, and also to Kim's questions to Pamela whether renminbi is going to be weaker because of that. So now, of course, we have an expectations where even through the statements, or at least the signals released by the PBOC about the level or the reference level of renminbi. It used to be 7.3 renminbi. At least that probably was like a psychological level that it shall not be crossover, but very likely that 7.3 level will no longer be on hold. So which means that it allows the renminbi to depreciate probably more further than that. So that actually will have impact on ringgit as well, to putting pressure on the ringgit depreciation. And therefore, and also that I believe that the reductions of the export subsidies, you look at the components of those reductions, they are mainly those primary commodities as well as EVs. So that, probably in a way, is a response to the world complaints about China exporting the overcapacities, because those industries, including primary commodities as well as the EVs, apparently they are in the least of having overcapacity being exported to the rest of the world. So that could be one of the perspective that we could look at that. And then another perspective will be that probably because like what Pamela has mentioned, they probably have to save the bullets in order to encounter whatever fiscal resources they have to spend later on. Now, so come back to Kim's question. So that geopolitical tensions the impact of this geopolitical tension, first of all, let me focus on Malaysia. Then I will make a summary generally about Asia. To Malaysia, it has basically two different phases. The geopolitical tensions, when it comes to between US and China, when it started probably since 2017, and then it officially became a what we call competition because of the tariff war 1.0, it didn't really benefit Malaysia that much. Because even though we have the hope that could it be like a Plaza Accord in mid-1980s where the factories relocated facilities to Malaysia, for example, it didn't really happen. Probably you have Vietnam as beneficiaries, but certainly not Malaysia for that tariff 1.0 for a very simple reason. If the tension, the geo-economic tensions occurred only within the boundary of tariff, then the impact of that relocations of or restructuring the supply chains will not be incentivized that much. As a matter of fact, the supply chain restructuring that we observed today, it was the outcome after the COVID and after when the Biden administrations imposed all sort of export restrictions on those high-tech industries, particularly in the semiconductors, and the so-called the small yard, high fence strategy. So it is because of that export restrictions, quantity restrictions that make the tensions to have economic impact on the rest of the world, particularly Malaysia, for example. So in the past 2 years, wherever FDI that we observe from China, from Europe, from the United States, so they are mainly the outcome of this kind of tensions. Now, so back to your questions after long stories. So would that be another round of tensions that will have impact on Malaysia, on Asia in general, or have no impact at all? It depends on not just the tariff, like what Dorian has mentioned, because the tariff is not just on the Chinese export, but from the rest of the world as well. But it is also Trump's position on other existing policies toward China. So whether this small yard high fence will be abolished because Trump's apparently show his disinterest in the Chips and Science Act. So if that is the case, and for example, including because of the transactional outcomes out of this bargaining, where they allow Chinese companies to set up factories in the United States and produce jobs there, then you can imagine that Malaysia as a place for these companies to hedge the risk, now that needs or the necessity will gone. So is that going to impact Malaysia, the kind of FDI inflows that the bonanza they observed in the past year will slowly diminish? So that was something that I believe that we shall pay much attention to.
All right, thank you, Professor Dr. Wong, for your sharing. So, Doreen, being a fund manager at Eastspring, we have seen that probably geopolitics have overshadowed the fundamentals of the economy, probably since the onset of Trade War 1.0. It probably may not be easy for for the client investors to navigate along the ever-changing complex dynamics in the market. So within your research coverage, what do you think the impact of the geopolitical situation around the globe might eventually face out following the election outcome?
Okay, we technically don't do research on geopolitics. Yeah. We only look at stocks, but looking at the market reaction, I think the first time news of war hits the headlines, right? Technically, people panic, market would just sell on jerk, right? It will come down, right? But as we saw even in the Russia-Ukraine episode, that was how it was. But very quickly after that, investors tend to learn to look through these kind of events, whether for better or for worse, right? The war has been going on for some time, and market has just been chugging along, looking past these kind of geopolitical events and looking at the fundamentals, right, of companies, for example. So this is in I think it was the first Q or end of first Q of this year, where there was an event, right? And I think Iran got into the picture or something like that, right? There was an escalation of some sort in the Middle East, right? And you know, we saw that market rebounded, right? I'm talking about I think it's the Malaysian space lah. Basically, investors who had swung into defensive positions, for example, would have lost out on part of the local rally. So that is the kind of sentiment, that is the kind of mentality adopted by investors. Whether that is the right thing to do or the wrong thing to do, well, that is market, and that is the kind of, or the lack of risk premium, for example, you know, that they have priced into the market. So the situation in the Middle East may actually be a little bit trickier to resolve, because I think Trump will continue to support Israel, right? And basically the whole thing has kind of like, you know, kind of included more and more countries, right? I think over, yeah. So anyway, when it comes to geopolitics, I think that is somehow, you know, how investors are looking at it. So kind of like immune, whether for better or for worse, you know, good or bad, kind of like this, until, for example, let's say something goes beyond the typical escalation, you know, like goes really beyond, and it is something out of the ordinary, for example, and then there will be another knee jerk.
All right. Thank you, Doreen. Over to you, Pamela. Probably we can zoom into the relationship between the US and China. So do you think the relationship between US and China will get better or worse following Trump administration? Probably if China can actually take this opportunity to convince Trump that they may actually, you know, relocate some of the operations, offices, you know, manufacturing capabilities to US, that may not be as bad as we think. Would that happen? Pamela, is there any things that you want to share with the audience? Over to you.
We do think that the noises between China and US is here to stay regardless. As mentioned earlier on, because Trump is quite unpredictable in what he does. But I think in the lens of China, we are actually not too bearish for a couple of reasons. Because number one, if you have seen, you know, the recent impact of the monetary and fiscal announcement in September and October, we have already seen some macro data improvement in October. So for instance, if you look at China's PMI data and also the service data improved to 50.3 and also 52 already. And this is the first time both above 50 since April this year. So that means domestic support is important. Also, we have, in terms of the takeaways from the National People Congress in November, which conclude on November the 8th, it basically suggests that because China announced a series of policy and also renminbi 10 trillion of local government debt resolution plan. And also along with that, bank recapitalization, consumption stimulus, and also property measures will be included in the government's 2025 fiscal plan. So this shows that China is really determined to further stimulate the economy. So we think going into 2025, we think there are some mega trends in China that's continue to take place, which will drive growth for China. If I summarize it, is actually, we call them the 4 A's. The first A is acceleration. So we believe that China's, again, the consumption, domestic consumption can continue to accelerate, and we do look and invest in some of the niche consumption sectors like tourism, domestic online music, education, e-commerce, etc. So these are very domestic oriented and which are immune from US noises. The second, the A is abroad. So when we say abroad, we think there are a lot of very strong Chinese companies that have strong brand equity and they have very good global footprint. It's spanned across many sectors, healthcare, industrial, EVs, whatnot, but a lot of them are already out there establishing R&D centers, strong production plants, and they bring along the suppliers. So these are some of the key areas we think still very strong despite China-US headwinds. The third A is advancement. So if we know that basically going to 2025, AI again is another buzzword, but AI adoption is really taking place. AI PC, AI smartphone, AI smart glasses, these are all coming in a big wave, in a big magnitude. China has a lot of supply chain companies focusing on AI smart glasses as an example. So still, we think riding on the tech wave, this is another way China can grow further. And the last A, the fourth A is automation. We think with the population demographics, China's automation industry has a strong structural growth. And also, if you look at some of the other segments, for instance, consumer picked up quite nicely this year. We liked some of the industrial companies that benefit not just on domestic growth recovery, but also riding on overseas market strength. Yeah. So these four A's pretty much summarize our thoughts in terms of how we think about next year for China. Yeah, and we still see a lot of growth opportunities despite the China-US relationship here.
All right. Thank you, Pamela, for your sharing. So we hear you on the four A's that could actually set a good picture for Chinese equities to go forward, ignoring some of the potential risks that probably US, the tension between US and China can bring towards the China market. So over to you, Professor Dr. Wong. Let's talk about Malaysia. Malaysia markets have been underperforming for the past decade, but starting from this year, we see some colors, right? KLCI has actually performed strongly year to date in ringgit terms, and even better in US dollar terms because we appreciated against US dollar this year. But of course, for the past 2 to 3 months, we see some profit-taking activities ahead. So what's your thought on the Malaysia market as we wrap up the year and look forward to 2025?
I think you are right to say that you don't see much excitement on Malaysian stock market for many years. Only probably the last year, within a year, then you start to see the excitement coming back. You have more IPOs in Malaysian market, even compared to Singapore, which is only one so far. So that kind of excitement seems to be coming back. But well, how? Okay, now let me before I want to address some of what Doreen and Pamela has mentioned before I jump to that. I completely agree with what Doreen has mentioned and has observed. Even though, like for example, since that the Russian-Ukraine war that took place in March 2022, and then you have October 7th last year, the Israel and Hamas conflict. But then the market really didn't react much. As a matter of fact, the market reacted more toward the Japanese, what they call DBOJ, the rates raised in August, and which affected carry trade, and then with associated at the same time with the release of the unemployment news, and at that moment that shocked the market. So which means that you notice that the market didn't really respond much to those geopolitical risks. As a matter of fact, they very quickly will somehow find a way to absorb all those news. So I therefore believe that when it comes to Malaysian stock markets as well, in the year to come, so it will be very much like it didn't really respond to, and won't have been affected too much by this geopolitical tensions indeed. But what really matters for Malaysian stock market from an economist point of view, and academic economics point of view, rather than from traders' point of view, will be it is whether we can, for example, two points. Number one, we can keep the momentum that we observe in the real economy right now, with all the exciting news about you have again which companies or which MNCs decided to invest billions of dollars in Malaysia for the next 5-10 years, and then you have data center coming over again. And then how about when it comes to in coming February, and then you have this signing MOU signing between Johor and Singapore governments about this Johor and Singapore free economies and so on and so forth. So you have to keep having this kind of news coming in so that it gives a reasons for the funds to rationalize their presence in Malaysian market. Even though I really don't believe that those news are actually driving them to come over because somehow Malaysia is just too small for them, but somehow they need some news to rationalize their decision. So so on one hand, you must have those news going on next year as well. But then on the other hand, I believe the second point will be whether we can, for example, to slowly liberalize our financial markets. For example, recently that Bank Negara allowed, for example, the non-residents, the multilateral corporations to issue ringgit bonds. For example, you must have allowed more foreign presence in our financial markets to make investing in Malaysia much easier. Then only then you can keep having those big monies coming over and keep exciting the markets. Otherwise, completely relying on domestic funds, retail investors, it won't be a long-term solution. So that would be two key points, I believe, that whether they are going to have some influence on our stock market next year.
All right, thank you, Professor Dr. Wong. Allow me to ask a follow-up question on budget 2025. What's your thought on the budget? We see that the unity government under the administration of Prime Minister Anwar has been trying very, very hard to narrow the fiscal deficit, through increase in the tax revenue, be it SST broadening, be it dividend tax and whatnot, and through cutting expenses as well through your proposed RON 95 subsidy rationalization. But at the same time, we also see some other parts of the expenditure, like more cash handouts, more cash handout, and in fact, the civil pension salary hike could also add some pressure to our budget. So what's your thought on the budget overall? Is it a good budget? Is it a satisfactory budget, or it probably is not up to the expectation? Over to you, Professor Dr. Wong.
I guess this budget 25 announcement probably was the most boring one. Boring one in the sense that you don't see much market reactions to it this year's announcement compared to what we have last year. And the ripple effect seems to be evaporated very quickly. Of course, for good reasons. Number one, of course, because we are already out of crisis, out of recession, so we don't really need to have much fiscal, injections into the market in order to, for example, to support the economy. So therefore, it's a time for the budget to go back to its long-term goal to support the 5-year Malaysia plan. So you see a lot of applications. Basically, they are more towards the same kind of structural economic restructuring, the kind of expenses. All right, so that's number one. And number two, of course, you're right to say that because of the Fiscal Responsibility Act, and then of course you must have fulfill the requirement that you have, for example, within a couple of years you have to meet the targets on the debt to GDP ratio of 60%, and you must reduce your deficit to GDP ratio as well. But I do not see how the fiscal consolidation will come mainly through the policy that you just mentioned. Because you are right to point out that on the one hand, you have all those tax base broadening through whatever SST tax base broadening. Then you have this the e-filing, for example. But on the other hand, of course, you notice that our what you call operating expenditure it's the expansion of our operating expenditure. It's more than the overall expansion of our budget expenditure. It probably increased by about like 11% compared to last year operating expenditure. So even though with the planning to rationalize our subsidies, but still you have that about 11% growth in the operating expenditure. So you don't expect that to be able to be helpful really meaningfully on our fiscal consolidation. I believe the consolidation will mainly comes from the economic growth that we can achieve, which therefore contribute to the tax revenue that we have. So yeah, that's how I see the budget this year.
All right, thank you, Prof. Over to you, Doreen. Malaysia market has been one of the top performing markets this year across most of the regions that we monitor, even among ASEAN as well. So what's your outlook for Malaysian market going forward and moving into the year 2025?
Okay, so we are expecting another year of positive returns in 2025 with markets earnings growth projected to be in the probably high single digits and a dividend yield of between 3 to 4%. The key drivers will include things like, a strong macro backdrop because, the real economy does matter, right? Strong macro backdrop with GDP growth of between 4.5% to 5.5% and decent consumption growth supported by, I guess, almost full employment, a minimum wage hike and a salary hike for civil servants. Additionally, the strong FDI multi-year thematic stories such as RE, data centers, 5G infra projects, as well as the recovery of E&E exports and the rebound in tourism will probably contribute to the positive outlook as well. Now, underlying all this is, of course, the strong domestic liquidity because domestic liquidity remains flushed in the system, especially from domestic funds, which will be a boost for the market. So generally, we are quite positive on next year.
All right, thank you, Doreen. So I think it's about 3 o'clock already. We may need to wrap our session, but before we wrap our session, we appreciate the feedbacks from our speakers, right? We hear you guys on how we should position ahead, how we should position following the outcome of US president election. There are some sectors that are going to benefit. There are also some of the sectors that not gonna benefit, and probably that should be an area that we could probably avoid in our investment positioning moving forward. So over to you, Pamela. In Manulife, there are a diverse range of products and unit trust funds that that could probably benefit investors. So would you like to highlight some of them that you think could benefit the investors in the year 2025? Over to you, Pamela.
Sure. And in fact, I would like to highlight Manulife Dragon Growth Strategy and also Manulife Greater China Equity Strategies. So both of them are Greater China Equity Strategies. So for Manulife Dragon Growth Strategy, it invests in basically structural growth opportunities and also companies with high dividend growth potential and ability to buy back. The strategy uses a barbell approach for the investment. So in terms of the areas of where the strategy invests in is mainly 3 areas. The first one is innovation. So we do think going into 2025, global smartphone recovery is intact. We can see smartphone supply chain is really benefiting from the recovery. Also, the new technology, Edge AI, is required for the next generation of AI phones. So what that means is you need the embedded language models, which can be put onto your mobile device right now for AI training purposes. So we see more AI adoption really coming in and coming in a big way. We think wider adoption of AI devices will benefit the entire supply chain. Also, areas such as AI wearable devices. So as I mentioned, AI smart glasses is really emerging. Right now, you can see very affordable glasses that can, do simple AI functions such as look and ask with lenses at the top of the glasses on both sides. So these and with a very affordable price. So all these basically allow more users to really use AI wearable device in the near term. And we also invest in the healthcare equipment companies. So some of these companies are innovative leaders. They basically make advanced medical equipment and with very good global exposure as well. And we like this area as well. Industrials, we like advanced manufacturers, and some of them have very advanced manufacturing capabilities with very good cost and performance metrics. So we are very selective through our stock selection approach. For consumption, we also like online, some of the niche sectors like online music, which is very under-monetized in China, but with very good growth. So these are some interesting ideas in Dragon Growth equity strategy. For Manulife Greater China equity strategy, it has a Taiwan component where Taiwan is a very unique place, which it has a lot of supply chain for the technology sector. Despite headwinds from US, we think Taiwan is actually still going to benefit riding the AI wave. So sectors that benefit ranging from foundries all the way to memories, display, AI servers, whatnot, etc. Yeah, so these are the two strategies related to highlight.
Right, thank you, Pamela. We hear you on that. There are probably pockets of opportunities within the innovation, healthcare, consumption, and Taiwan tech, and foundry and memory sectors. A follow-up question on that: what about property sector? What will trigger you to probably relook at the property stocks again?
Yeah, our investment team thinks that the property sector is currently gradually recovering in China. Although we have seen, improving secondary transactions, but we think it will take a little bit of time for, the sector to fully recover. But in terms of valuations, we think, versus 5-7 years ago, in terms of stock valuation, it may not be able to reach that level because the sector itself is going through its cycle right now. But we think there are other areas that are more attractive in a way in terms of the growth prospect in China.
All right, thank you, Pamela. Doreen, are there any funds or products that you would like to recommend that could benefit investors at this spring?
Okay, I would stop short of recommending funds directly, but I'll talk through some strategies. I think investors who favor growth may continue to, overweight the US, for example, because of the US exceptionalism, so to speak, out of this whole Trump presidency that is expected, right? And then I think India is also looking okay. But of course, we have to be mindful of the valuations in the US and India at this point in time because they are not cheap. In contrast, China, for example, although China may suffer slower growth, but I think that the policy pivot is real. Yeah, the government may implement more stimulus to boost sentiment. And generally, most funds are very underweighted China. So any positive development may trigger a re-rating in the China market as valuations are attractive. And I think we all saw that firsthand in the end of September when market just shot up, right, sharply, right? Now, coming to this part of the world, of course, Malaysia, we like the Malaysian space at this point in time. We are positive on it because of the few drivers that I just mentioned earlier on. But having said that, overall, against a more volatile backdrop, truly diversification is important. Yeah, and active security picking will be key to driving alpha in Asia, in emerging markets and all that, while portfolio risks must be managed more carefully in a more volatile global economic environment. So I think I would like to end on that note. Thank you.
All right, thank you, Doreen. And finally, to you, Professor Dr. Wong, do you have any final thoughts to our audience today?
All right, so I will not have strategies to give to the audience. Otherwise, I don't want to bring you all to Holland. But I want to resonate the viewpoints of Doreen and Pamela that although next year very likely will be a fast-moving kind of world, so while we are afraid of the escalations of the geopolitical tensions, but don't forget that when we talk about Cold War is there to prevent hot war. So, which means that the risk actually has already been contained in that perspective. And also, when we are afraid of the escalations, that we observed recently between Ukraine and Russia, because of the abolishments of limitations of the long-range missiles. But that escalation usually it's a prelude to the coming negotiation, because each one will want to like have a stronger hands in the bargain. So you probably will observe peace coming over sooner than later. And even, for example, in the Middle East, you start to have news, for example, even Iran will ask the Hezbollah to stop the escalation with the Israel, and the Israelian foreign ministers have been all over to Europe, even to rumors to have approached Mars to Elon to have a peace talk kind of. So yeah, so in that case means while you are afraid of risk volatility, that could, the spring could come much faster earlier than one expected. So be ready. And to like what Doreen said, be more diversified in the portfolio, but be ready for the spring to come earlier. So that's probably my thought on what you have asked for.
Right. Thank you, Professor Dr. Wong, for your sharing. I think our audience greatly benefited from the sharing by our speakers today. We have Professor Dr. Wong from the Professor of Economics at Utah. We have Doreen, Head of Investments from East Spring Investments, and finally Pamela Yao, the Managing Director, Client Portfolio Manager at ASEAN Equities at Manulife Investment Management. Thank you so much for your sharing, and also thanks to our audience for your great support to the speakers and to Phillip Capital Malaysia. That's all for today. Stay tuned for our next Phillip Roundtable. This update is brought to you by Phillip Capital, your partner in finance.